Hey, this is Mark the Meerkat with Grok Trade in for Des with the weekend review, and I'm going to add a lesson to the day. So let's get right at it. Let's take a look here first at the charts. It was kind of a quiet day on Friday, even with horrible jobs numbers, and we'll talk more about that later when we get to the lesson. Horrible job numbers. They were off by 500,000 jobs in their prediction for an added job. So what effect on the market? Nothing. So let's take a look here at the S&P 500 daily chart here, first of all, and let's kind of notice what's going on with that. So here we are. It's riding up here and riding up here. It closed at all-time new high on Thursday. Just pull back just a fraction here on Friday. Let's pull this out a little bit here. But I want you to notice what's going on here. If we take a look and we go back here multiple months, and what do we have here? We have what's called a rising wedge. Rising wedge is a bearish pattern, but it is coming back to this all the time. But what's really coming back to is, look at this. When it falls down like back here in January, it fell right to that 50 moving average. Tag that, rolled right back up. Came back here, it pierced the 50 and then came right back up. Came back to the 50 moving average, this blue line, rolled up. Came back here to the 50 moving average. Now that's one, two, three, fourth time. Came back a fifth time, a sixth time, a seventh time, and this time it almost got back to it. Now, in our mentoring program, we talk about the fact that the age of a trend as it goes up, that each time it pulls back, it has a swing low and goes up. That's like being 25 years older in your life. So right now we did that, what, 1, 2, 3, 4, 5, 6, 7, 8 times. This is a 200-year-old uptrend without a correction. So folks, probability wise, this market's going to turn down. And it has all kinds of reasons that it could and all that stuff, but the point is, it just statistically, it's getting very out, on the bell curve, it's way out there on the very edge of not going to be keeping going up. Now, doesn't mean that it can't. It's just probability wise, we're likely to have a correction here. 5, 10%, I don't know. But right now, personally, I'm invested 100% in the long market. But I am also being very aware, because there's a few other things going on here. If you look down here at the bottom, the MACD, we're getting higher swing highs here over the last several months, and we're getting lower swing highs on the MACD. That's thunder in the distance. Watch out. There is a thunderstorm in the distance. It might be sunny here, but that means we could get wet, aka the market could turn down. Internally, it's weaker than the actual price action. And then, of course, volume here, it's been summertime. We're in the summer doldrums. It's been relatively low. It's below that 20 moving average running in general. So, yes, that all happens. Well, now it's September. And here's another thing that they all talk about about the September market. Well, if you look at just more recent data, yes, September is one of the months that it tends to be a down market, not an up for a month. But if you go all the way back and look at all the data, it's actually just one of the more volatile months. Another month is also March. So you got September and March, two of the most volatile months out there. But none of them are losing months when you go back to the 1800s and look at all the market data. So if you look at all the data, yeah, they are more volatile. So expect more volatility here in September than on average of the other months. But my point is here that added with we're here at a 200-year-old trend, yeah, we could expect a downturn. Now that doesn't mean that there's not opportunities and that we should just all go short right now. No, you have to wait till it does go to the downside to get out of your longs and start to look at your short positions. But until then, let's keep riding this beast up higher, and it's with lower volume, but it is going up. But not all sectors, and we'll look at that in a few minutes. So that's the S&P 500 daily chart. I know I had a lot to say about that one. Well, what about the Dow Jones Industrial Average here? Well, it's up there, but it's not getting it. It is pulling back, but it's not pulling back to the 50 like the other one was. Not as predictable. Still going up here, but its new all-time high was back here on August 16th, was the last high close, and now it's sitting just under that. Rather than the Nasdaq continues to get them over 35 of them, I think, so far this year. Here's the Nasdaq. It was the Nasdaq. I'm sorry, they keeps getting them. So here's the Nasdaq. It's also in a rising wedge, which is bearish, but it is not as it had a pullback here, not a full 5% correction, but it's still running up here. It's now above this upper trend line because we don't have a swing high up here yet, and it did have a new all-time high close on Friday, so we are still riding that up there on the daily chart. And then we've got the one that has been lagging, and that is the smaller cap Russell here. Now look at this. This is just, look at that, just lagging here. This is, you can tell it's in consolidation if you just look at the moving averages. Look at them. They're all crunched together here. There's the 200. There's all of them just bundled right together. It's been in this tight range all the way since February. It went into this tight range. It could go either way here. It's a bit of a symmetrical triangle. But right now it is lagging the rest of the markets. It hasn't had a new all-time high on the daily chart since back here on March 15th. So yes, that one is lagging. So again, it is a generally bullish market, but then again, the smaller caps, they're just going sideways. And a lot of the picks that we have in our V newsletter is the fact that it's what they are the smaller cap ones. So this has been a little bit harder to get good results on. They have not been growing nearly as fast as a sector, the smaller caps. All right, and then we got bank here. Bank is similar to the small caps. Look at that. It hasn't had a new all-time high since over here, I think, in May, and it's just been drifting all summer long. Now, how about the VIX, the Volatility Index? What is it looking at? Now this is interesting. Again, if you notice, every time it dipped, it was about once on the S&P, about once a month, it would make a dip down to that 50 moving average and come up almost once a month, every month. Well, look at here. The VIX, the Volatility Index, aka the fear factor, would spike about once a month, come back down, spike, and then comes back down. Little spike, bigger spike, about once a month. It's spiking up when the market takes that little dive, whether it be on news or whatever is driving that. But then the market gets over it and it starts to ride up again. So that's where we're at right now. We're here at 16.4 is where it closed on Friday. And again, since COVID, being down here, in the 15 range is the calmest it's been here. Just since June that we were able to get down to that range. A year ago, we were in the 60s, outrageous for weeks at a time. So it was so volatile at that time, but we're not there right now. And but we're also not down. Now prior to COVID, the year before COVID, we were in the 12 range, and even down to 10. We even set some all-time lows for the VIX index itself. We were actually below 10 at one point, 2.5 years ago. So we're not in that area, but we are riding lower. That's the good news. All right, so and let's take a quick look here at Bitcoin here. It's back up here at the 5,000 range, but it's been high basing right under it. But look at this here, Ethereum. It was basing, high basing right here, and then boom, above the 34,000. It's now up here to 38. Now this is live data right now. It's at 38.82 as I record this on Saturday afternoon, just after 1 p.m. Alrighty. Now, so that's what we're looking at on the broader markets here. But that is just on the daily charts. So let's go to the weekly charts and see where they are at on the broad markets here. So let's go back down here. Let's take a look at it on the weekly charts. See what do we see there? Again, a rising wedge here, bearish pattern, but it continues to ride up here. Whoops, that's kind of odd. There we go. There, it should be right there. And now it's just breaking above this the upper resistance line here. And again, new all-time high close on the weekly chart here for the S&P 500 as well. Now the DIA, we look at that, and it was symmetrical, but it's not much of a, it's not the rising wedge like the other one. It's kind of a flat top here, and again hasn't had a new high for the last 4 weeks on the weekly chart close. Now here's the Nasdaq. Look at this, running up here. It was just flat on the weekly for almost a month, and then boom, last 2 weeks taking off again here, a new all-time high close on the weekly chart. Small cap Russell, now you can really see what I'm talking about here, about it being in consolidation here. Look at that. The low down here was in March of 2000. Okay, this was the drop on COVID, and then it ran up, and then it was spacing, and then a beautiful run up here until about mid-February. And now it's been in just consolidation since February, folks. So yeah, the smaller caps has been much tougher to try to trade those on a swing basis, just because as an overall, again, 70 to 80% follow that index that are in the small caps. It has been harder to make money in that arena. All right, so they're going to let now. We just closed the month of August, so let's take a look here and see on the monthly chart what is it telling us. So looking at the monthly chart here, look at the S&P 500. 1, 2, 3, 4, 5, 6, 7 monthly candles in a row. The S&P has been bullish, green, up 7 out of 7 months. So that's telling you that the large caps here are strongly going up. That's good news, right? Now, are we at the end of that? I don't think so, but we'll see where it goes from there. What about the DIA? Well, the DIA, which is the ETF on the Dow Jones Industrial Average, we look at this one, and there on the month of June, it was a down month here. It closed slightly lower than it had opened, but it 5 out of 7 months. I'm sorry, 6 out of 7 months. It has been higher. Can't count that. That's just just a couple of days of trading. Now, what about the Nasdaq? Well, but now it's interesting about the Nasdaq. 8 out of the last 10 months, it's been up. 8 out of the last 10 months, right in here, they're just barely closing. It was flatting. It was flat here on January, February, and March, with some real wicks down here in those areas. But 7 out of 10 months, it has been. I'm sorry, 8 out of 10 months, it has closed higher on the monthly basis. So, are we in an uptrend? Absolutely. Have we had a major pullback here? Nope. We haven't had a major pullback well, you can see the big pullback back here in 2000, the beginning of COVID, and we had another one here September, October of last year. And then and here you can see again on the small cap Russell ETF, it ran up, but it has been in consolidation here on a monthly basis for 1, 2, 3, 4, 5, 6 months. For 6 months, it has been in consolidation when you look at it on the bigger time frame. All right, let's take a look here at the sectors. Go to finviz.com, under groups it's called. We can look at the sectors. It does this, by the daily basis, which, so what? But for the last week here, real estate, technology, and healthcare led the way up, while financials will pull back here in the last week, as well as basic materials. We look at 1 month performance. Again, we just closed August, and so August here, technology, communication services, and real estate were the top 3, very strong. Basic materials were the weakest, and consumer cyclicals. Now we go back for 3 months, again, taking a little broader and broader look at this. And again, technology, communication services, and healthcare were right up there. Real estate was growing. Well, energy, it had a bad summer there, and it's now pulling back up to a 3 months highs here, but it was down for quite a while there. And basic materials there, they were down the most. And then we look over just the last year here. Take a look at the last year. Look at this. Again, consumer services, financial, technology, and energy were just boom, 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 boom over the last year, while consumer cyclicals, utilities, and consumer defense were all positive, but not nearly as strong as these up here. So that's just taking a look at sector rotation a little bit there. Let's go back here to our charts and just look at a couple of let's look at the FANG chart, at the FANG stocks here. So let's go back to the daily charts, and so let's take a look at Facebook. Where has it been here? Again, is it following like the S&P? Look at this. It pulled back to the 50, pulled back to the 50, pulled back to the 50, pulled back to the 50 moving average. Interesting, right? It's following along with the S&P, or is the S&P following along with it? Since it's in the S&P, and it's a very large cap stock, as is Apple, one of the largest cap stocks out there. But it was not doing that. What did it do? It was in a tight range here until May, or until 1st of June, and then it made a beautiful run up here, and then it sat here from about June 15th until the last day of August. It sat under 150. This is called an ascending triangle here. So there was a trading opportunity here if you to get in on Apple, and it did break out here above at 150. So that was a nice opportunity there on an ascending triangle to get into Apple. Now, again, just for disclosure purposes, I am in Apple in my really long-term account, my long-term investment account, and I've been in that one for years and years, but then added to it at different times. So yeah, that's at new all-time highs up here for Apple. And then we've got Amazon here. Now it's been more, it has not been following the S&P. It's been more herky-jerky here. And again, on earnings, look at that gap down on earnings. Never hold over earnings, folks. Look at that. You never know what's going to happen. Bam. Yeah, you'd be upset if you were in that one on the shorter term, if you traded over earnings. But it could have gone up. It could have, but that's a gamble. It's 50-50 if it's going to go up or down. And I don't only trade when the odds are in my favor. Anyway, we're pulling back here, and then we're riding up here. So we went down to 32. Now it's up here to the 3500 range on Amazon. Again, for disclosure purposes, I do own this in my long-term account. Yeah, I got in this. I remember with my long-term planner, he goes, you ought to get into this. You ought to get into this. You know, the market shifting from, storefront to more online. And I say, yeah, I don't know if it's going to break the 1,000 mark. I just don't think it'll break the 1,000 mark. There's a psychological barrier there. I got in at 990 something, two different lots at different times. I guess he was right, huh? We're up here at 3,500 now, when I virtually got in at basically 1,000. Then we got Google L here. Again, now this one is like following the S&P. So this is, if you're in this one, this just let your winner run, baby. Setting your stop below that 50 moving average. Yeah, beautiful, right? And just let your winner run there on Google L. And then we've got Netflix. Again, it had earnings drop down after its earnings, and then we're just basing here, and then kaboom, and then had a little high base here, and boom again. So this one though, and if you go back over time though, it's been basically in consolidation here after its big run up in 2020. And then the last one here is Microsoft. It's been running up here relatively gently. Look at that, it had a beautiful high base here, just couldn't get past the 290 mark. Just couldn't get past it, and then ascending triangle here, just like we saw in Apple, and then boom, broke out, and now it's just high basing up here above what the even $300 mark, which was once resistance, can now become support. That's on Microsoft. All right, hey, before I'm going to go into a lesson here, if you want to stick around for that. It's on one of my trading rules. But before we do that, I just want to talk about, if you need a trading education. I mean, if you're just trying to wing this on your own, good luck. Gather as much free information as you can online, and good luck sorting it out. But if you want a systematic way to be looking at the markets and setting up your trades and doing them in a responsible, logical, rational way, consider our mentoring program. Now, our mentoring program, go to groktrade.com, and let me tell you about our mentoring program. It starts with 3 days of concentrated education, which is taken from about 8 days worth of training from other companies that Des was associated with before, and things that we have learned, and I've learned in my 30 years of investing, and Des has learned over his lifetime as well. And we've consolidated it down to just 3 very concentrated days. That's the knowledge that you need. But what's missing in most programs is that they might give you the knowledge or information, but they don't show you how to apply it so you actually make money over time. And so what in our mentoring program, you start with the 3 days of concentrated, but then we coach you from that point forward and be your mentor. It's someone that you can learn from and help you apply it. So it's just like if you're learning to fly, you first do the ground school. That's our 3 days of intensive training. Then you go to a simulator. You paper trade until then. You don't get into a fighter jet right out of your ground school. No, you first go into a simulator, simulate your flying first, so you don't, if you do crash, it's all simulated and you're not actually getting hurt. Then you're going to not get in the fighter jet. You're going to get in a little Cessna and you're going to be in the pilot seat. But then we're going to be in your co-pilot seat. You're doing the flying, but we're there to coach you so that you can gently lift your accounts up over time here. And then eventually you're going to get up to a double, two prop plane, and then if you wanted to get fighter jets, years of training to get to that. That's where you can go with this. But most people just want to get in the fighter jet and they skip ground school and everything else, and they think that I know what I'm doing. Just pull back on the stick and I go up. There's a little bit more to it than that. So join us in our mentoring program. If you want more, learn more about it, go to this groktrade.com. Go here to our training mentor here page, and it talks all about it here. And then what you want to do is to just fill out the a discovery call form, and we'll just talk to you about your trading. Not a sales call, just a discovery call. We'll talk to you about your trading, where you're having issues, and perhaps if our mentoring program, again, this is a long-term program. This is not just a spew a bunch of information on you, and then we coach you from that point forward. And so go ahead and give that a try, and we'll talk to you about your trading and see if it's going to be appropriate for you. So what I'd like to do now is to move into the lesson part of this. So again, if you've had enough information, that, if you didn't like the ad, you're already gone anyway. So here we are. This is a lesson, and this lesson is on my trading rules, and it's called So this lesson is based on Meerkat Trading Rule number 10, and that it reads: "It's not the news that counts; it's the market reaction to the news that counts." And in other words, your friggin' opinion doesn't count. I'm sorry if that offends you, but that's just the truth. Your opinion doesn't count. When there's news out there, your opinion doesn't count. It's what the market takes it, and it's not just the market, but the majority of what the market does, and that will move it. And I'm going to give you several examples of that just from today's Investment Business Daily publication. All right, so let's go to Investment Business Daily here, and I'm going to talk about some of the news. And we're going to talk about the jobs reports here. Now, that job report I referred to earlier, here it is. And that was that they were supposed to add 700,000 new jobs in August. Everything's coming back. But they only added 235,000 jobs. That's a miss of almost 500,000 jobs. There's 500,000 people that did not get jobs that they thought they would. Now, you have to understand, we have over 10 million job openings. We're at record high of job openings out there, but people aren't taking them. And what we find out is, we look at the data here, sector-wise, because of this wave of the COVID variant is now starting some restaurants to shut down again, and some other areas. So if you look here into this news again, it says that in July that there was 450,000 jobs that were added in the hospitality and leisure area. In August, there were 0. Whoa. I mean, 0, from 415 to 0. So again, that's a telltale sign there, right? And so that's just one particular area that really dropped. Now, the other thing here, and that's the second part of this news here, is that on Labor Day, on Monday, they stopping the extra $300 a week / that's $1,200 a month extra payment to unemployment. Now, that has been removed in many of the states, but there's still 24 of the Democratic states that were still paying that. So people were being paid $18 to $20 an hour not to work. So to fill, even a $15 an hour job, why would I work for 15 when I can get paid 20 for not working? So that's going to go away in some of the states. But so you've got this teeter-totter. You've got those payments of people not taking jobs, and you've got the And then you have the COVID part of it, in which, yeah, things are starting to shut down a little bit here now. Now it looks like some of the data here this past week, some of the hot areas are starting to turn down slightly. We'll see if this wave is now has peaked or not. But the point is that that's just a telltale sign of what could be happening. But what was the market's reaction to this news? Today on Friday, nothing. I mean, the market, they were slightly up, waiting for the number. They got the number. The markets went a little bit negative. And then throughout the day, I was trading in my day trading chat room. It was just fluffing around the zero line. So the Nasdaq ended up a little bit, and everybody else down a little bit. Or it was mixed right around the highs of the previous day. So at the close of the previous day. But so it wasn't. You would think that your opinion of that may be, this is horrible news, but market, no. So you see, if I'd only try to short the market and go big short on my shorts because that's going to crash the market. See, it's not my opinion that counts. It's only the market's opinion that counts. So you don't trade what you think the market's going to do. You don't trade what you think the market's going to react. You trade what the market is reacting, and that's on the charts. All right, let me give you a second example here about Zoom. And Zoom, look at this. Zoom, record high, 48% increase in their earnings per share, 54% in their revenue. Unbelievable, right? And it had a severe drop on Friday. Why? Because, or on the day this was, because they said, well, we think we're just going to be flat next quarter. Now, of course, they'd exploded because of all the at-home stuff that was going on during COVID, and now they're staying out in the next 3 to 6 months, which is what the market always looks out 3 to 6 months. You have to remember, it's looking out 3 to 6 months, and they see that and they say, oh, we're probably just going to be flat. We're not going to have this extreme growth. Why? Because all these small businesses and everything else, as they start to more and more return to normal here, and you don't have all the all the schools that are at home. Zoom isn't going to be growing as fast. Well, tank on their business. So again, in this case, record sales, record earnings, unbelievable growth, but crashes on its earnings. Because why? The market is looking out 3 to 6 months, and so that's you have to remember that. So again, I can look at the chart, and I know what the market's interpretation is of their earnings. I don't care what their earnings was. I want to look at the market's reaction, and where do I find that? On the chart. So let's take a look at Zoom's chart, and you'll see what I mean. All right, here's the Zoom chart, and here was their earnings here on Tuesday, and look at that, kabam! Well, yeah, bam! If you were holding that long, and you saw the first two numbers, you say, "Wah!" Your opinion doesn't count, and then but the market think. Look at that gap down here. In fact, let's measure that and see where from the close down to where it closed. It was down 15% on the day. 15% you would have lost on there. And if you just had a stop in place, what would have happened? You would have opened up here about -12, -14%. That's where it opened. That's when your stop would have been activated and you would have been out there. So stops do not help you on gap down, gap up situations. You have to, don't trade over earnings. If you're a short-term trader, don't trade over the earnings. Period. It's a crapshoot. It is gambling. So please, please, please don't do that, because you never know what's going to happen next. This is Mark the Meerkat. Have a great trading week, and until then, trade well, and may your winners run.